You know that feeling when you check your portfolio, and the red numbers make your stomach drop. You stare at the screen. You refresh. You panic. You tell yourself you need to do something, but the truth is, the more you watch, the less control you actually have. My name is Manuel, and I spend way too much time running forensic audits on the invisible equations that keep investors trapped in the volatility cycle. If you've ever felt like the market is working against you, hit that subscribe button. Because today, we're not trading. We're building a cash flow architecture. We're going to break down exactly what a $150,000 dividend portfolio actually pays you month by month, not in theory, in real calendar math. And we're going to prove why patience outperforms prediction every single time. Before a single dollar is deployed, you have to understand the mindset. Dividends aren't a lottery ticket. They're a payroll system. A company shares a portion of its profits in exchange for your capital. That's it. And when you reinvest those payments through an automatic dividend reinvestment plan, you're not just saving cash, you're buying more shares. Those shares generate their own dividends, and over time, the system feeds itself. That's compounding. Stripped of the hype. This setup removes the pressure. The payouts arrive on a schedule. The reinvestment happens automatically, and time does the heavy lifting. With that mindset locked in, selecting the right companies becomes a structural exercise, not a guessing game. Filter 1, stability. Companies that have printed profits through recessions, inflation spikes, and market crashes. If they've survived 3 decades of economic weather, they're starting from strength. Filter 2, dividend history. Not just paying, but raising. Consistently, year after year. You want income that grows without you adding a single new dollar. Filter 3, payout ratio. If a company pays out more than 60% of its earnings, the dividend is fragile. We want sustainability, not desperation. Filter 4, sector diversification. Consumer staples. Healthcare, utilities, industrials, real estate. You don't want all your capital concentrated in one macroeconomic basket. Filter 5, payout schedule alignment. Quarterly payers meet monthly payers. You want the cash flow to smooth out, not cluster and starve. When you apply these criteria, the portfolio builds itself. We divide the $150,000 into 4 equal pillars. Each gets $37,500. No single sector dominates. The income stays balanced. Pillar 1, broad dividend ETFs, instant diversification, lower volatility, the anchor. Pillar 2, blue chip dividend stocks, established companies with decades of reliable payouts. They don't change much, they just print cash. Pillar 3, real estate investment trusts, high yield, often monthly. They smooth the timing gaps between quarterly payers. Pillar 4, growth-oriented dividend stocks. Smaller yields today, but massive payout expansion potential over time. But here's where the psychological trap snaps shut. Most beginners chase the highest yield. They see a 10% payout and ignore the fact that the company is bleeding cash and about to cut it. They expect every stock to pay monthly and get frustrated when the calendar doesn't align. They concentrate in one sector and get crushed when that sector rotates out. Or worse, they take the dividends as cash too early, breaking the compounding loop before it gains mass. Let's run the actual holdings. The anchor, STI, the Schwab U.S. Dividend Equity ETF, yield 3.75%. It screens aggressively for cash flow strength and sustainable payouts. It's the portfolio's shock absorber. The blue chips, Procter & Gamble at 3.03%, Coca-Cola at 2.9%, PepsiCo at 3.93%, Johnson & Johnson at 2.6%, AbbVie at 3.1%. These are the utilities of human consumption: cleaning products, beverages, healthcare. They pay through inflation. They pay through recessions, and most have raised their dividends for over 50 consecutive years. The REIT, Realty Income Corporation, yield 5.67%. It pays monthly. It leases to recession-resistant tenants. It's the calendar smoother. The growth dividend layer, Air Products and Chemicals at 3.1%. Nexstar Media Group at 3.76%. Consolidated Edison at 3.55%. Industrial stability, media cash flow, utility reliability. They lift the payout growth rate while anchoring the downside. Now, let's run the calendar math on the 150,000 deployment. Dividends don't arrive in equal slices. They stagger, and that's the design. January, April, July, October, the base months, anchored by Realty Income's monthly payout of roughly $71. Added to that, Procter & Gamble drops $114, Air Products $117, AbbVie $117. Combined, they form a dependable floor. Roughly $420 each of those months. February, May, August, November, Realty Income still delivers $71. But now, Nexstar Media steps in with $141. Consolidated Edison adds $133. Johnson & Johnson contributes $98. The floor lifts. You're looking at roughly $440. March, June, September, December, Realty Income delivers at $71. SHA drops $141, Coca-Cola $109, PepsiCo $147. These months carry the heaviest weight, roughly $468. Zoom out, and the full year generates roughly $5,316 in dividend income. That averages to about $443 a month. Now, I know exactly what you're going to say. $443 a month on a $150,000 investment. That doesn't replace a salary, that doesn't buy freedom. And you're right, not yet, because year one isn't the destination. It's the ignition. This portfolio isn't built for instant gratification. It's built for exponential scaling. What matters isn't the $443 in month 12. It's what happens when every single dollar is automatically reinvested. Year 10, with dividends compounding and payout growth averaging around 6% annually, your portfolio value crosses roughly $430,000. Dividend income climbs to nearly $15,000 a year, roughly $1,250 a month. That covers mortgage interest, car insurance, groceries. You're no longer funding your lifestyle entirely from labor. Year 20, the curve bends. Portfolio value approaches $1.3 million. Dividend income crosses $50,000 annually, over $4,000 a month. You're looking at the option to reduce hours, to step back, to work because you choose to, not because you have to. Year 30, the compounding engine hits full velocity. Portfolio value surpasses $3.8 million. Dividend income crosses $185,000 a year, roughly $15,400 a month. That's not a paycheck. That's a financial architecture. Fully automated, fully independent, fully yours. And out of that $3.8 million, over $2,600,000 of it was never your money. It was generated by time, by reinvestment, by consistency. The system wants you to trade, to chase, to react, to believe that $400 a month is failure. But failure isn't small income in year one. Failure is breaking the compounding loop because you lack patience. You have to shift your metric. Stop measuring weekly balance changes. Start measuring annual payout growth. Ask one question: did the portfolio pay me more this year than last? If the answer is yes, the architecture is working. Ignore the noise. Fund the system. Let the calendar do the heavy lifting. So how do you operationalize this? Step 1. Equal weight allocation. Deploy $37,500 into each pillar, or scale it down to your current capital, but keep the ratios. Balance prevents fragility. Step 2. Drip mandate. Dividends do not go to your checking account. They buy more shares, automatically. This is non-negotiable. Compounding requires frictionless reinvestment. Step 3. The 5-year silence. For the first 60 months, do not react to market rotations. Do not sell during volatility. Do not chase higher yields. Your only job is to maintain the structure. Let the curve form. Step 4. Annual payout audit. Once a year, review the payout ratios. If a company cuts its dividend, replace it with a stronger candidate. But do not overhaul. Adjust. Then return to silence. Step 5. Liquidity buffer. Before you deploy a single dollar, ensure you have 3 months of living expenses in cash. This prevents forced selling during market downturns. Protect the compounding engine at all costs. This isn't about getting rich quick. It's about building a payroll system that doesn't require your presence. And once you understand that, the volatility stops mattering. The headlines stop triggering you. The monthly payments become background noise that quietly funds your life, I want to hear from you down in the comments. Are you currently building a dividend portfolio, or are you still stuck in the volatility trading cycle? Drop one or two below. I'll reply with a specific allocation adjustment based on your exact capital and income goals. If this audit shifted your perspective, share it with someone who's still measuring their success by daily price swings. They need to see the architecture behind the illusion. Hit subscribe. I'm Manuel. Outsmart the system, protect your capital, build your buffer. I'll see you in the next deep dive.